tonight's Zoom at 8. My name is Julianne Peterson, and I am your host tonight. You know that I am with Old Capital Lending. We are a premier provider of debt, not only in multifamily, but other asset classes as well. We close 5,800 loans so far, $1 billion a year. So not only are we bringing the debt, but we'll also help find a sponsor or an LP, a limited partner. Or, you know, if you're looking for a insurance broker or an attorney, we've got those as well. So keep us in mind. We have a lot going on today. We just came from the Old Capital Conference, and that was a hoot. 2 hours, I'll tell you, talking. And then Merrill left and did some more work on his own, and now he's back, and I am so excited. We not only provide some learning for you, but we are extending the time, and I'm hoping that you guys will stay with us. I work with Merrill. I met Merrill probably 2 years ago. Merrill is, he's great. You've seen a little bit of his personality. He and I go back and forth. His wife apparently is just as crazy as him. I haven't met her, but I've connected with her on Facebook. I do most of my business with my partnerships on the attorney side with Kaliser and Associates. We do a lot of business with Cindy, his partner. And, you know, if there's something that Merrill can be involved with, he will be. He and his buddy Jeff are just like, they got their hands in everything. So one of the things that I found out that Merrill was doing was funds, and I heard about it. I saw some huge investors getting involved, and I wanted to know more about it. We are hearing a lot about funds out there, and I think it would be most important that we understand the good, the bad, and the evil about these funds. And so I asked Merrill, hey, can you come? Because there is an urgency that we understand the legal aspects of this. And also, like, depending on what state you're in, you know, I'd love to start my own fund and be able to help my clients not only do the debt, but also the equity. So one of the kind of part of this is that I'm selfish and I want to hear it directly from Merrill. So I thought I would share that time with you. And Merrill is in Dallas. He's doing some incredible things. He's got a project that he's working on that, you know, at some point you guys need to learn about it because it's pretty exciting. Merrill is a father. He's a parent. He's a same thing. He's a husband. He just does some amazing things in this world. So I want you guys, as I've said, for many of the people that I bring, you're like peanut butter. You just want to spread them around. So Merrill, I could go through all of this information and talk all about it, but I really want to know about funds, and I want you to share it with my friends here. And you've got like 30 minutes of our attention, and you're on mute.
30 minutes. You told me you were going to go long, and now you're saying 30 minutes.
We've got such a group of people that, you know what, if we need to go long, we'll go long. I know that a lot of people here have a lot of questions.
Okay, so I really appreciate it. And I paid Julie to say all that, just so you guys know. So I am the smart ass lawyer. So don't take anything personal or get offended. I may use a four-letter word that I try not to use often, but I get excited. I also encourage class participation. This is school. I'll spend 30 seconds just elaborating on what Julie said about me, only because it gives context as to what I'm talking about. So it's like Hair Club for Men, you know, that guy that used to do the commercial, you know, you should use Hair Club for Men. I'm not just the owner, I'm also the user. So I don't need Hair Club for Men, maybe a little bit, but I don't just, or my firm doesn't just tell people how to structure funds. I also have been doing them since 2008 myself. Currently, I've got 2 helium drilling funds in, I told you, she said I do everything. 2 helium drilling funds in Northwest Arizona for the drilling and excavation, extraction of helium. I have a medical marijuana in Oklahoma. Look at all you California people like, yeah, big deal. Not a fund because those are illegal. So there's no fund there, but that's an investment that was structured under Oklahoma law, completely legit. I think Julie was talking about a development project that I have 3 partners on in Leander, Texas, which is a suburb of Austin. It's actually the fastest growing city in the country right now. And we've got $1 billion development project that just was announced by the city, big press release on Wednesday, TV, all blah, 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 kissing babies, being fake, all that stuff. But it's a great project. We're putting a 4-acre crystal lagoon with a white beach entry that people can utilize in the middle of a multi-mixed use 78-acre development. Really cool. It's not a big deal for you Californians and West Coasters. We don't have water in Texas, okay? And if we have water, it's brown. And if we have beaches, they're brown. And so our kids, when they're really little, they don't know what to do with clear water and a white beach. They go to Florida, they run away. It scares them. But this will be a white beach, really cool. At the end of the tram, 30-minute rail station from Austin. I just got accepted an LOI on a 316 unit this morning in Houston. Pretty excited. It's going to be a big capital raise. I can talk about it, unlike most of you that just did. I'm just kidding, Julie. I'll have a discussion about that in a few minutes. Yeah, it's probably a $15 million raise. And I did a few single family. Anybody out there, raise your hand if you've done single family. Okay, I'm not bragging, but I've done more than all of you combined. Not going to brag because it's something I never, ever want to do again. But myself and another partner, we bought, rehab, leased, and sold over 9,500 single family properties between 2012 and 2019 in Dallas, Houston, Kansas City, St. Louis, and Indianapolis. And it was fun. It was a nightmare. And it was like having a colonoscopy every single day working with private equity funds. So stay away from private equity funds unless you really enjoy colonoscopies. All right. So that was me. I got everybody warmed up. Now we're excited. Now I'm going to put you to sleep talking about funds. And so I think when I'm going to share the screen in a second. And Julie, you're allowing me to share the screen, right?
Yep.
Okay. So I'm going to share the screen in a second. I just want to make sure. So Julie's talking about funds. And the reality is all of you guys, gals, when you're putting something together to buy an asset and you're pooling more than one or two people, pooling more than one person's money together, you're creating a mini fund. Okay. But I believe what Julie is probably emphasizing more is we just came out of the COVID scare. Thank you. That was my wife. We just came out of the COVID scare, at least in most parts of the country. And so Q2 and Q3 were basically non-existent. Now you have Q4, you have all this dry powder. Dry powder, I know I'm from Texas. I'm not talking about gunpowder. This is actually capital. It's how we call capital in Texas. Dry, gunpowder, we just call that candy. So they have all this dry powder sitting on the sidelines. And so what a lot of people do, and every one of my funds are 506C, I'll call them open funds, not blind funds. I hate the word blind. It's probably going to be outlawed pretty soon anyway to use the word blind fund. So these are open funds. And so people are trying to capture the dry powder that's out there for a lot of reasons, because everybody's going after a deal right now. My firm is representing 53 acquisitions right now that are trying to close before end of year. There's an enormous amount of business, most of which is going to Old Capital, which is very good because, they're the go-to lender. But more importantly, if you figure the average deal is going to raise $5 million in capital, which their average is probably like $7.5 million, take 50 times $7.5 million. You're taking, what is that? 50 times 7.5. Your $370 million in capital is going to be scooped up in the next 60 days just from my firm, not my firm, but my clients. And I know it's hard to believe there's more than one SEC lawyer out there. And we do have a nice niche and we do a lot of SEC transactional work and real estate work. But, there got to be 50 or 60 other syndication firms out there doing similar, not as good, but similar work. That's a lot of capital out there. So what people are trying to do is they're trying to pool their capital together. So Julie wanted me to talk about funds. And it's the most boring topic I could ever talk about. So I clearly want you guys to ask questions and Julie to interrupt me. She's like, why did I put Merrill on? He's going to talk about boring. I'm not boring, so I'm going to make it fun. I may call on people, but since I'm not in control of mute and unmute, I may not call on people. So I'm going to go over, I'm going to do the share screen. Again,
I do have a question.
yes. You stopped me in full sentence.
Can you explain dealer broker since you're not really
So,
going to follow anything?
you don't, since I'm not following my spreadsheet, two things. So I already did the Old Capital, their national convention, which is phenomenal last year. I'm very upset it wasn't in person this year, but they're doing a really good job kicking it off. But I also do a Tuesdays with the teams. A couple times I've had Julie on. Actually, Julie was a guest on it for an entire hour. I feel sorry for her. She had to deal with me. But
it was great.
We have fun. But tonight I spent an hour talking about the new proposed rule by the SEC that would pretty much make most of. Thank you. You want to say hi?
She's a good waitress.
Sure. Yeah. Let me tell you, her fee is way more than you can imagine. So anyway, so I from 6 o'clock to 7 o'clock, I did my own deal. We had a couple hundred people on there, and I talked about the new proposed rule. Many of you probably aren't even aware of it. Some may be. If you, Julie, I think you're giving me everybody's contact information afterwards. I will have Roxy or myself. We will forward it tomorrow. If you like, I can just forward you a copy of the 1 hour, and it has the PowerPoint that explains it. But in a nutshell, the SEC has proposed a rule that is now out for commentary by broker dealers, lawyers, and other people in that area for any last minute comments before they make it a final rule. And so I believe this is as close to the final rule as possible because they created an informational video on it by the SEC, a chart and whatnot. So what it does is it allows people, I'm going to just call on names. It allows Mandy, who has got a fund and she's raising $6 million and Mandy can only come up with 4. She can go call Rodney and say, hey, Rodney, do you have any investors you can bring me? I will pay you to bring those investors to me. You guys are like, what? Everybody, or they should have, who's involved in SEC law should have told you, you cannot pay people to bring capital in unless they are a broker dealer. And I'm telling you, if you guys are approached by broker dealers, run, because no broker dealer worth his or her weight in gold would ever raise capital for one of us. And I say us, meaning myself too. True broker dealers have investors that are putting in anywhere from $5 to $100 million at a time. $100,000 is a waste of their time, doesn't generate enough money for the work that they do. What this rule is designed to do is it's designed to help out the little people. And that's okay. We're all little people making lots of money. There's nothing wrong with little people making lots of money. We're considered little people. You're doing deals that are 50 million, even 100 million. You're considered a little person by the SEC. We don't have access to broker dealers, and they want to still continue to stimulate the economy by having transactions move, and we're considered small businesses. So they are allowing an exception that my guess is will be approved sometime in Q1. I think it'll get final approval Q1, probably February, that allows people to go out and bring capital to Mandy. There are restrictions. There will be a lot of potential fraud. There will be people that will get in trouble, but there will be others that have realized, and you listen to my podcast, my Zoom call right before, it's video too, and I'm a smart ass on that one also. There's plenty to go around. But you'll listen that I actually propose that there's a way that many people listening right now will find that as an actual career. At the end of the day, you're a bird dogger. I used to be in single family. I mentioned that before. I call wholesalers bird doggers. I call wholesalers other words too, but I'm not going to say it on here. But I call most wholesalers bird doggers. They're looking for finder's fees. The hell, they don't even own the property. They get under contract. They assign the contract to you for 10 grand. They could care less. I'm not minimizing the opportunity of people to bring in capital, but there's some very serious restrictions here and I would say blocks in the way to do it the way I would like. I think it may be changed. Just one thing to keep in mind, there are 2 types of people that can do it. It's called a tier 1 capital finder and a tier 2. And don't take notes, Julie. You're going to get the whole presentation later. I can see you on that tall screen in the top left. I give her a hard time. Sorry.
Overachiever.
So the tier 1, tier 2, real quick, you cannot be an entity and be someone who brings capital to syndicators. You have to be a natural person. Now in California, that encompasses a whole lot of different things, but in Texas, you're just either male, female, or other. I'm just joking around, guys. Don't take me too seriously. But you have to be a natural person, which means you can't be unnatural. So that includes anything that's living except for an LLC, LP, Inc., trust, whatnot. So right now you've got to be a natural person. If I were to comment on it, and I may, my suggestion would be to allow LLCs and LPs to participate so that you could have a more professional company doing it. The idea, though, is the broker dealers lobbied very hard against this. And so they don't want a professional look. They get more things. I could spend 3 hours talking about it. I'm not going to do that. But Julie wrote it up. I will say that I am the black and white lawyer. I don't like gray. I think I didn't I do a PowerPoint 50 Shades of Gray?
Yes, you did.
It was on law, nothing else. Because everybody, I always tell people, don't go too gray, and there's different shades of gray. So anyway, what Julie asked you to do initially, with many of you who she already knows, talk about what you're looking for. I would have said to Julie, I would have emailed her a spank emoji if that is possible, and said that's a no-no, because she just told you guys to go and talk about deals in which you're looking for capital right now, active deals. Okay. Only one person, I can't remember where that person is, but I gave a field goal to, said, I'm doing a 506C. That's the only deal that you can do what Julie just said to do. However, I'm getting gray and decided to go a little gray on this. I am making, I think, a very good argument can be made for small, Julie, don't take it the wrong way, small Zoom calls like this, small meaning it's 50 of your closest and best friends. And you guys have followed her, most of you, there are only a few new people on here, and you have dialogue with her, and you correspond with each other. And I do the exact same thing. I tell people, put your information down on the side so you guys can talk, mingle, chat. I don't say put what you're looking for on the side, but Julie just took it one step farther. Long story short, I would argue that this might satisfy the pre-existing relationship. I'm going to say might. So I was joking around, holding my ears, but I heard every single thing you guys said. I too have deals, but I'm not going to tell you about them. And mine are 506C because it's not about me. It's about Julie today. But just be careful. And I think you're probably okay in a group like this. Be careful, though, if you're doing a 506B, that's when you're not allowed to do advertising, and you've got to have, you can have 35 sophisticated investors. I'm going to go over that in a second, and the rest are accredited. Be careful publicly announcing what you're doing unless you're doing 506C, because what it is it's a competitor of yours that listens and says, you know what? I'm just going to go call the lawyer in Salt Lake City, and he is the one who goes after everybody right now. And there are many people in our social ecosystem that are under investigation for raising capital the wrong way. So again, I'm not trying to scare people, but please be careful in what you do. I see a good argument for doing what Julie does because I've been on her show or her Zoom for a couple times, and I do see some of the same people. But yeah, I would keep it in this deal. All right, so Julie, funds.
We're talking about funds.
Yeah, I'm gonna do my fun thing now. We're gonna have fun.
Let's talk about funds. Yeah.
Well, can you see my?
Yes.
Can you see the PowerPoint?
Yes.
All right. It helps if I do. You guys are gonna see the people that actually do the work. This will be cool. So, there. That's Cindy. She's kind of my chief lawyer, and that's me from 10 years ago. And actually, that's me from 15 years ago. That's Greg. He's our associate. We've got 2 paralegals and another part-time lawyer. So we focus mostly on syndications and real estate, and we do it in just about every state, including Alaska. What is a fund? See, I can see it next to me. What is a fund? So a fund is a sum of money saved or made available for a particular purpose. I did not come up with that definition. That's Wikipedia, and you know it's got to be right. Actually, that's Investopedia. So basically, a fund is you're pooling money together. All right. If Daryl goes out and looks up at the ceiling and says, "I want to buy a new fan for $100," and brings in 2 of his friends, he's still looking at the ceiling. Sorry, Daryl, I just happened to see on my screen. You look at the ceiling and he wants to get Rob and Gil chip in $50 each, he's creating a fund. Daryl's going to put the fan together, and Rob and Gil are just providing the money. They're passive. So everything you guys are doing, with an exception, you need to create a fund. A fund it can be a group of 5 people getting together, it can be a group of 500 people getting together. The exception is if Daryl, now I see JT and Julie, JT just grabbed something in an envelope, looks good. If Daryl, Julie, and JT decide they want to each put in $100K, so they'll have 300 grand to go after a 10-plex, it's $1 million, and they're both the managers in that deal, they don't need to put together a fund, because neither Julie, JT, or Daryl are passive. They're not going to be passive investors. They're each going to be a 1/3 manager. So if they're a manager, you don't have to register with the SEC, because you're not selling a security to someone. You're opening a partnership with someone who's going to manage that investment. In addition, they're going to get a security, but they're putting money in and they're actually managing. They have risk. They have risk besides just their investment. That's the idea. So there is a way to get around it, and it's not even getting around it. We advise people, and it's not to our best interest of our pocketbook, but rather than going through the whole SEC, even for small deals, if everybody is truly acting as a manager, and they'll come to us with just bad legal advice. We were told we need to get a fund. There are 5 of us. We're each putting in $200,000, and we need to set up a PPM. And I'm like, okay, so a PPM for what? Are you raising capital? Well, no. Each one of us are putting in 200, and this person's doing this and this and this, and they're truly managers. I tell them, okay, well, it's not going to be thousands and thousands of dollars. It's going to be $2,500. They look at us like they're crazy, like we're crazy. But I said, you don't have to file. You don't have to file with the SEC. You don't have to put together a PPM. You don't have to do disclosures like you normally would, because you're all managers. Julie, does that make sense to you?
Yeah, that makes sense.
Everything is based on Julie's approval. All right, yes. So we only have 612 slides to go. I kind of just said, we're on slide 3 of 15. When do I need to use a fund structure? I kind of just told you guys, just about any time. Anytime you have a passive investor. If someone doesn't know what a passive investor is, you can ask Julie. She can explain it. But a passive investor is someone that does not have any liability other than his or her investment. I give you 100 grand. Don't talk to me until I see a return. That's a passive investor. Julie,
how have we done this in the past? I mean, we haven't been doing funds. So why all of a sudden are we doing funds and everybody's doing them? Why?
So listen, I'll say it again. So an LLC is a fund. Okay. There's a misconception. I don't know if it's a misconception. The terminology of fund, you're putting together an LLC or an LP. Whether the LLC pools 5 people together or 500 people together, it is still a fund. There is no technical term that defines the difference between a 5-person fund and a 500-person fund. Now, you can have a fund of funds which pools together money that then goes and invests in multiple other funds. You can have a mutual fund, and I think everybody knows what a mutual fund is. It's a fund that's created to pool money together to buy separate stocks, and they're diversified as a mutual fund. And they're also investment funds that are very similar. They buy ownership interests in other entities, but they're still funds. So your fund is still an LLC or an LP. And Julie, I don't want you to get too hung up about funds, but what people are really, the reason funds are being talked about so much right now, as opposed to, yeah, we're just going to set up an LLC or LP, people are trying to capture 2 things. They're trying to capture dry powder. And when they say funds, they're referring to setting up a blind fund. A blind fund means I want to capture the money now. I don't know exactly where I'm going to put it, but I have a very specific set of parameters as to what I'm looking for. And every one of my deals are blind funds. I don't call them blind funds. I call them opportunity funds. I call them open funds. I think blind is, it already sounds like there's something wrong. You're missing a sense. There's something wrong. It's blind. Yeah. And it's probably not politically correct to say anymore. So we call them just can't see funds. Kidding. But I call them open funds because we do want to capture. We hear about all the money that's sitting on the sidelines. We want to capture that money. And
but if you're in a deal right now where some of these folks have a deal right now, they don't have to build a fund to collect the money. They can simply have them sign a PPM and sign up with their money and go and close, correct?
yeah,
You don't have to have that fund.
So Julie, that PPM is the fund.
Okay.
So the PPM is kind of your, that is your eye candy for your company agreement. Your company agreement, your LLC says, we are buying 123 Main Street for $5 million. There's going to be a Class A and Class B, possibly a Class C units. This is how they're going to get paid. There's a subscription agreement at the very end saying, I'm investing blah, blah, blah. And if it's a 506B, there's an investor questionnaire where you have your investor, potential investor, answer the questions. They determine whether they're accredited or not, which is good. You don't have that liability. And they're investing in your fund. So that is a fund. That is a fund. Now, I just like to call them LLCs and LPs. You can call them a fund. You can call it peanut butter and spread it all over the place, like you said.
That's it.
Yeah, I've never been compared to peanut butter. I'm not even sure how to take that, but we'll talk about that later. And is it Jif, Skippy, organic? I don't understand. All right. Why do I need to syndicate? This is kind of what we were talking about. So syndication is real simple. You're exchanging capital or money for a percent ownership in interest. Okay. And you're doing it under the federal and state security laws. So the federal laws state, the SEC law states real quick, that you cannot take capital from any person and give them a security without being a licensed broker dealer. Okay. I'm going to repeat that one more time. You cannot sell a security of your fund or LLC to, let's see if I can get the names right, to Corey. Just picked a different name. Sorry, Corey. You can't do it to Corey unless you are a broker dealer. Okay. With the exception of under Reg D, there are certain exemptions. Almost everybody on here will elect to take a 506B or 506C exemption, which says under certain restrictions, you can sell securities provided you do it this way. All you have to do is just file with the SEC, but you're not really registering. It's a one-time filing, and you need to file with every state that's outside the state you reside in which you took an investor's money from that state. Those are called blue sky filings. So if I live in the Republic of California and I take money from someone that lives in the United States, I was just joking around with California. I take money from someone in Utah, I have to file with Utah's Board of Securities stating, hey, listen, I'm exercising the Reg D 506B or C exemption. And you file with Utah, and maybe Utah charges $200, or it's New York that charges $2,500. So on large capital raises, it's not a big deal. On small capital raises, we advise people if they're outside of New York, not that I don't like New York, but New York charges the most amount of money. I wouldn't take one investor with 25 grand because you're going to pay $2,500 to the state of New York. Losing 10% of that money is not worth it. But if they're going to bring in, $2 million and you're only paying $2,500, you don't really care. So there are different things to think about as you're doing this.
Who files those?
We do.
You yourself?
Well, not me. I'm the boss. Come on, bite your tongue. Cindy and Greg and our paralegal file those. So it takes about an hour's worth of legal time, and then whatever the filing fee is. It's the lowest billing rate's Greg's billing rate. So typically we have some that don't file anything. All their capital comes from the same state. When we have clients that are doing 506C, which tells you how you can raise capital. We have one right now where they've got capital from 19 states. It's a big capital raise, a $22 million capital raise. And, but their filing fees are probably, with the filings, probably 14 grand, 15 grand. But compared to the amount of capital they raise, that's nothing.
I'm curious about that. Where does that money come from? Where does the $14,000 come from?
Well, glad you asked, Julie, because the PPM was already created before you take the capital, correct? Chicken before the egg. So you will have had this discussion with your lawyer, and your other partners as to whether you want to use funds from those that have been collected to pay for it, or you want to use your own funds and get a reimbursement on the closing. But at the end of the day, it should be, for the most part, it should be the fund that pays for it, because it benefits all the investors by being fully funded. And it benefits all the investors by having the money in play quickly versus having to delay and extend. Their money's not making interest. When you go back to what I initially said, for those that want to grab that Zoom that I did before, when you're paying somebody to bring in capital, you need to be aware of how much you're paying, because that's where I think Julie's question really comes into play. Bird doggers are going to charge between 3 and 8%. And if you're paying 8% for capital, it's coming from somewhere. If someone's going to bring you $2 million, you're going to cut them a check right then and there for 160 grand. These people do not stay on as managers. They don't have a manager's ownership interest. You don't want them as your manager. You want them as your bird dogger, finding you capital. But you also have to be prepared to explain that to your investors. Hey, we took the 2 million, but 160 is coming out to pay for it. It gets spread out, amongst the entire fund, but we're paying for it. And I can envision 2 days before close, someone not having enough money and that costing them 10 or 15%. I used to be a hard money lender. Shocking that I did something other than law even 15 years ago, but I had a hard money lending business and we grew it to $40 million, and we were helping people buy fix and flips and rentals. And we were 14% and 4 points for a 6-month loan. And we were a lender of last resort. And I would tell people when I would go and talk at events, you don't use us until there's absolutely nobody else you can use. We are not cheap at all. Don't use us until you absolutely have to. So you're going to see different types of tier 2 capital raisers. You're going to have the professional ones. They're charging 3%. Yeah.
So I hear we're talking about blind funds, but we're not calling them blind funds. But I want to grab all of these people in California, especially who have all of this money, but I don't have it identified. Okay. I don't have it identified for ABC or BCD, right? It's just, I'm grabbing it. So how do I do that?
You don't. You first talk with an SEC lawyer, and whoever that person is, hopefully it's our team, but whoever you talk to, you tell them what you want to do. So you say, hey, Merrill, I have all these friends because I'm the most popular person in California, which I know you are. Yes. And I could be influential because I know about financing. I've looked at just as many deals as they have. I want to play with everybody else, kind of like what I do. I would sit, or Cindy or Greg or whomever you talk to would sit and say, okay, where do you think your friends are? Are these just Facebook friends, that you think you can do that? Or are these people that you have had, pre-existing relationships with, blah, blah, blah. And how much money do you want to raise? And then it gets to, you're kind of jumping around, but I just went over the Reg D exemption. But then it gets to, how do you want to pay your investors? Because what people don't realize is when you're doing a fund, here's the basics of a fund. So when someone asks you how much is your capital stack or your debt stack, does anybody know what that means? Anybody raising their hand? So you have a deal. It's a $10 million deal. You're going to be nice and give us 75% financing at 3%. Yeah. And the other 25%, I'm going to raise capital, and I'm going to end up paying my investors an IRR of 20%. So they're going to get the effect of 20% a year on that deal. So that means, so for everybody that's listening, 25% of my capital is costing 20%, and 75% of my capital is costing 3%. So you just blend that, and I can't do that in my head, but I'm going to argue that that's somewhere around 7% or 8% as an average. Okay. So you're always looking at what your cost of capital is. And just so you guys understand, Julie is your best friend ever. All right. Mm-hmm. Best friend ever. Because Julie is selling you guys the cheapest capital you will ever get in your entire lives. And quite honestly, Julie, it's not about you, but it is. She is giving it to you at the best price you'll ever see, or I'll ever see again in my life. I'm pretty sure that it's possible it could go a little bit lower, but it's only going to go so far. It's as low as I just got quoted 2.7 something. I'm laughing. 5 years interest only, 30-year term. I'm like, no personal guarantee. Like, where do I sign up? You know?
Yeah.
But I want 85% of it. I don't want 73% of it. Why do I want 85%? Because I want to make more money. So people, here's what you can do. This is kind of legal advice, but it's also business advice. This is what I like to do. Structure different classes. If you know that Julie is going to have to pay 20% to her Class A members on an average basis, that's a lot of money. That's not giving Julie a whole lot of money. So maybe there's some investors that want more like a coupon. They want to know they're going to get 8% a year. They don't want much risk. Bonds aren't available anymore. T-bills are paper. It's toilet paper. It's cheaper than paper. But they still want a coupon. So when you get people like my age or older, you know, I'm not that old, but they want more stability versus risk. And so why not create a fund, an LLC, whatever you want to call it, that has a couple classes. I'm working on one right now that will have a Class A that has a 10% preferred return. Okay, that sounds exciting. Class A members have a 10% preferred return. Class B have a 7% preferred return. Okay, so Evangeline, who is, you have a different name. I can't remember what the name was, but you, what is it? Lila. Much easier. Lila. That means night. Much easier in Hebrew.
Yeah, somebody told me.
Yeah. So you have your Class A and your Class B. So if Class A is 10% preferred, Class B is 7% preferred. You know, why would you do that? The Class A 10% preferred, they get paid first each quarter before anybody else does. They're preferred first. When you go to sell or refinance, all they do is get their money back. No upside. They get their money back. They get their money back first. So are you guys telling me that you can't find investors, especially if you're doing 506c and marketing, that don't want the risk? They want to make sure they're paid before anybody else, and they're fine with a 10% continued return until they get their money back, and they're still going to get to take advantage of the accelerated depreciation that they get. Then your Class B is a 7%, and you make that a 70-30 split. So you have a 10%, a 7%, and then your 3%. And that 7%, let's say it's the same thing. That 7% pays, it comes out to be 20% annual. But instead of raising whatever, $5 million of Class A, now you have $2.5 million of Class A and $2.5 of B. So the Class A is only costing you 10% total. So you already know you're going to get more money as a GP because you're not paying everybody outside the lender 20% annual. So there are different ways to look at it. And I find it shocking people don't spend more time on determining who their target investors are. And it doesn't have to be the same group of investors. You want to make something that is palatable for everybody. You want to make a hot dog. Okay. Lots of people eat hot dogs. Less people eat bratwurst. So you want a hot dog so you can attract as many people as possible. And then there are different variations of that. So anyway, that answer your question, Julie?
Yes, I have a question though. Now the fund is Class A fund and a Class B fund, or
No.
okay.
No, Julie, we need to talk.
I know.
I know we do. So when you have, so we're going back to the LLC. You have Tandy's smiling. Tandy and I went through this a long time ago. So you have an LLC, and your LLC, you're selling ownership interests. So you can have all your ownership interests equal to each other. So I sell an LLC, I have an LLC, I've got members and I've got managers. I already know my managers. I want every one of my members to be treated the same. So my Class A are my investors. My Class B is the general partner, or we would call the manager. So in the simplest of scenarios, and I would draw on my screen if I could right now, I probably could, but I'm not. You have, I mean, I can't really make it much easier. You do an 80-20 split.
Yeah, it makes sense.
Class A is 80%, Class B is 20. Class A owns 80% of the company. Class B owns 20% of the company. Mm-hmm. And then if you have more units, you can separate out the percentages. Now, the advantage of doing an LLC or an LP, why you see nobody doing, have you ever seen anybody doing Inc. as a fund? It would be suicide, quite honestly. You don't do an Inc. as a fund. LLCs and LPs are the only entities where you can give a disproportionate return that is not equal to the ownership interest. Either way, either more or less. Same with voting rights. If you own a share of a stock in an Inc., you own one stock, you have one voting right, and if your share is 1/1 millionth, you get 1/1 millionth of the distribution. However, I can create a deal where I give Julie a 20% interest in an LLC ownership, but I'm only paying her 10% of the return. Or I can give Julie a 20% ownership interest and I'm paying her 30% of the return, but she only gets 10% of the vote. So you get to a lot of, I don't want to go into details, you get to a lot of cool things. And also if you bring on a GP that you need his or her money, but kind of has a little bit of an attitude problem or whatnot, then you talk to your lawyer first and you structure in a way so their voting is disproportionately less than everybody else's. And then you make the majority percentage to pass something high enough so they can never block your vote. That's a little sneaky, but I call that chess. Play chess. You got to ask yourself why you're taking that person in the first place. If you don't really trust them, is there easier money? There will be Q1 of next year when they pass this rule. But in the meantime, you pick some ugly ducklings sometimes. So Julie, without further ado, I'm going to Reg D, 506B and C. This is what I was telling you guys. Most of you guys violated 506B technically by responding to Julie's questions. Don't worry. I think there's a very good argument that under Zoom, you're cool. 506B simply states that no marketing. All right. You're not general marketing. You're marketing amongst yourselves. And quite honestly, someone was asked you to talk about it, but still, it's great. But I would approve this one, especially in light of what we've just gone through in the last 6 months. This is really the only form of communication. But you're not allowed to market. You can't go post on, I wouldn't do this. I wouldn't have Julie post on Facebook, hey, everybody that's got a deal is trying to raise capital, and she knows that, come see me. You cannot do that under B. You will be investigated by the SEC, not because an investor turned you in, one of your competitors turned you in. I see that all the time. I had 3 emails today from people that said, are you allowing such and such to do it? Well, first of all, I'm not allowing or disallowing anybody. They happen to be former clients of mine and I don't control them. I try to be nice. And I try to advise people in a Facebook Messenger, not message where it's not public. Hey, if I were you, I might take it down, but I'm not your lawyer and I can't tell you what to do. And the other thing is under 506B, you can take sophisticated investors. So a sophisticated investor is very simple. It's an investor that makes $200,000 or less a year, or makes $300,000 or $200,000 or more a year, or $300,000 or more a year that is married. Other caveat is if they don't meet those 2 requirements, either one of those 2 requirements, if they have $1 million net worth, excluding their house, because even shacks in California cost $1 million, then they're qualified as an accredited investor. If they're not, they're deemed a sophisticated investor. So you can bring on 35 sophisticated investors. Yippee. I hate sophisticated investors. If you're on here, I apologize. I don't hate you personally. I hate you generally. Okay. They ask the most questions and they have the least amount of money in the deal. All right. So I don't know what to tell you guys. You can still do a 506C and have them all accredited investors, which is what I recommend to all my clients. If you're doing a decent raise of over $3 or $4 million, the most you're going to get a sophisticated investor to put is 50, 75. If they're putting 100K of their money and they're sophisticated, which means that's more than 10% of their net worth, okay, they're going to be calling you and emailing you every frigging day, okay? You're going to produce the most legible, and I call it KISS, keep it simple, stupid, bi-weekly or bi-monthly update. They're going to call you and ask you about every single sentence. I'm not making this up. This is my life. I have lived through in 2 funds, and I've never brought in, those the first 2 were with 2 partners. That's the only time I've done Bs. I've never brought in, never done my own 506B and never will again. I don't think so. So be wary of sophisticated investors. They are not sophisticated. Okay. It's just a term of art. Listen, many accredited investors are not sophisticated. in the sense of they know what they're doing. But you get a break because the SEC believes they're smart. And so as long as the government believes they're smart, what do you care? But be careful with the sophisticated investors. And, the argument would be you got people that are younger, that are just coming up and they want to get involved. You're going to let your friends, if you're doing a 506B or so, you're going to let friends and family. It's called the Friends and Family Fund. When you do 506B, most lawyers refer to it as, oh, you're doing a friends and family raise, because you can't really talk to anybody that you don't have a pre-existing relationship with. And who better to steal money from than your family, right? It's like insurance sales. I know JT's on here, but he doesn't really sell the same type of insurance. I'm just giving him a hard time. So then we have 506C. That's the opposite. That's my favorite. That's called ultimate capitalism. So we have 506B, which is socialism, and we have 506C, which is capitalism. So under 506C, see, I woke Tandy up after 3 glasses of wine. She's now, you're making it political now without making it political. Under 506C, you're free to market to the world, okay? Not everybody is equal. You can market to the world. Be careful what you market, though. Once you put it on Facebook, it's like I tell my kids, 2 daughters in college, you can't take it off. So be careful what you put on there. You put 10% here and 8% there, someone is going to call your ass on it. Okay. So be very careful what you put. Every investor you market to must be accredited, 100% accredited. Now, sorry, not market to, take in. You can market to the world. You don't care if homeless people see your investment, which would be weird how they'd have Facebook if they were homeless, but that's another story. But you don't really care. What you care about is the money that's coming in. That money that comes in has to be an accredited investor. You have to make that determination. They don't fill out a investor questionnaire like 506B where they say, oh, I have 10 grand in the bank account, but I'm accredited, so I want in on this deal. You have to prove it. You do not want to do it yourself ever, ever, ever. Don't accredit them yourselves. Don't accreditate them yourselves. Use a company in California that I've used for the last 8 years called Verify Investor. It's $59 per person. You buy a package of 10. I say package because it's online. I don't know why I did that. But you buy a package of 10 and you just use through them. And typically within 12 hours, you get a certificate. If it changes and someone calls you on it, they defend you with the SEC. Love it. No liability on you. I'm a lawyer and I don't want to see my clients or my investors' financials. The easier way, and you give all of your investors the opportunity of not having to forward anything. We provide in our package, we provide a affidavit that literally your CPA just has to put in his or her name and then have it notarized. So, and they all have notaries in their office. So the CPA just has to say, yeah, they meet they satisfy the requirements of the SEC. They're accredited. Boom, move on. And so I like those. I also will do higher raises. Our last average raise was $157 a person with a 506C. So you have to, and the raises range from, $75,000 to $675,000 per person. I like that. You're never going to get that doing a B or doing a 506B without marketing. All right, blind fund. You want me to spend 2 minutes on it? Because I know it's your time, Julie.
Two.
2
minutes.
I'm going to spend 60 seconds. Okay. Blind fund. It's simply a fund where you don't have a targeted asset. So in order to do a blind fund with people, with investors, you have to show them, 1, you know what you're doing. 2, you have very strict targeted parameters. And I always put where everybody's deal, I always go back in when they're doing a blind fund or open fund, subject to market conditions. I always do that, or subject to opportunities. You always leave yourself a little window. It's the lawyerish in me. I love blind funds because I want to do multiple assets. I like diversification. I hate one deal, one LLC. Not a big fan of it. I like spreading the assets out. And Julie, to make her life easier, I create a separate LLC for each one of them. So the lender knows it's just loaning on that. Then the fund where the money is owns 100% of each one of those LLCs and just pushes the necessary money down for closing. And then because it's a blind fund, you're asking for money up front. So Lila is saying, hey, invest 100 grand with me today, but I may not find something for 5 months. Like, screw you, Lila. I don't know you. I don't even know how to spell your first name. Why would I do that? And Lila would be, well, hold on a second. Just coming from New York doesn't mean that you don't have to trust me. That accent doesn't make me a bad person. What you can do is I've got a deal where you can put 20% down now. And then when I find the deal, I just do a capital call for the remaining amount. but I am Lila and I'm New York and I'm tough, and you F me and don't give me my 80%, I'm keeping your 20%. You get nothing. That's the worst case. The best case is the more gentle Texas Merrill side would say, I'm not keeping your 20%, but I'm going to take 25% of your investment and distribute it to the other investors. You harmed them by doing that. We relied upon you by doing it. But hey, lucky me, I listened to Merrill. It's an open fund, so I can go raise more capital because somebody screwed me. Sorry, Lila. And then your open period, you leave it open. I leave them open for 2 to 3 years, subject to manager's discretion. That was 1 minute and 47 seconds. Sponsors, real quick. I'm not going through all of this. You're going to get this in the PowerPoint. Guys, you need to pick your sponsor, co-GP, partner in crime. I don't like to use the word crime, but whatever you want to call it, your partner. You need to pick them like you pick your spouse. Actually, you need to pick them better than you pick your spouse, because 52% of you are divorced. Mm-hmm. And I don't like to see 52% of my clients have LLCs break up, because they're worse than most divorces. It's shocking. You need to be picking your partner like you are picking somebody you were stuck with for the next 5 to 7 years. Mm-hmm. You can go through this list later. Do not be afraid to ask for any one of these things, because Julie is going to ask for most of these things. Mm-hmm. When it's time to go to the lender and the lender wants their due diligence, you don't want a friggin' at the last second because Lila said she was perfect, but she used to be a gangster in New York. But it was the Greek mafia.
Used to have bar fights. Fights.
Yeah, she was the bar. She promoted it. And, they had fighting in the back, whatever. Fight Club, right? Fight Club.
We don't talk about Fight Club.
We don't talk about Fight Club. Sorry, Julie. But so I can't stress this. This is probably the most important thing you ever do before you create a fund is pick the right partner. Do not be afraid to ask the questions. If you don't ask these questions, you have no business doing a fund. I'm dead serious. You have no business doing a fund, because you will set yourself up for failure. Like I said, I'm positive. And this is real simple. When you structure a fund, make it so that you're not starving yourself, but also keep in mind, if you were an investor investing in this fund, would you want to see an acquisition fee, an asset management fee, a refinance fee, and a disposition fee? Most of you were saying, no, I don't want to see them getting paid all that money. But if you're getting 85% and they're only getting 15, or you're getting 90, they're getting 10, you realize, hey, I need to incentivize these guys to keep working. So I see why they're getting the fees. There's a nice balance between kind of the fees you can take up front. These are called upfront fees, really. And then the fees you get on the back end with your split. So, talk to your lawyer, talk to your investor base. You can always poll them in advance. Hey, what do you guys think of if somebody did something like this? Well, before you have a deal, so you haven't violated any SEC, I would always do polling with your current investors. You have your own investor groups, always send them polls. Not Polish people, but polls where you ask questions and they
surveys.
I'm trying.
Yeah.
Capital stack, already talked to you about it. This right here is definitely it. Well, I don't know about hard money. You can find hard money. This is all Julie. Julie is your second most important thing. You'll always raise capital. If it's a good deal, you're not going to have a hard time raising capital. Debt is complicated. You need Julie to walk through it. There's no question about it. I use Julie's, am I allowed to say his name?
No.
Julie? Okay. I use somebody else that's in the company because I've known him for a long time. I met Julie after the fact, but we push people to Julie specifically because she's more accessible, much more accessible. And then listen, Waterfalls. If you guys are bored, go to Kaliser Law, YouTube. Just look for Kaliser Law, YouTube. I've got all of our videos, whatever. We did a whole thing with Don't Go Chasing Waterfalls by who? TLC. We even have some music in there and we have them dancing. I was trying to be funny, but this, I think we had one of the most attendances on Waterfalls. People love to figure out, how do I structure my deals? Can I put a cap? If I pay my investors 15% annually on the deal, can I take a bigger percent? You can do anything you want if you think your investors will put up with it. That's the reality. And the more experience you have and the more good deals you have, the better you structure your deals for you. And then it's the investors begging you to invest in the deal versus you begging them to invest with you. Exit. You know what that is? That's the end of my PowerPoint. Know your exit strategy before you get into a deal. Julie wants to know your exit strategy before you get into a deal because it determines what type of financing Julie's going to look for you guys. So, and don't just have one exit strategy. I tell all clients have 3 different exit strategies. Okay. And then communicate those with your investors in the PPM. That way they're not holding you to one. We could do this, or we could do this, subject to current market conditions. 5-year exit strategy, subject to current market conditions. Who knew COVID was coming? Well, I don't know. Someone might answer they knew, but who really knew COVID was coming 8 months ago, 10 months ago? Nobody. But COVID has caused many deals to go and sell right now. Pissed off a lot of investors. But this is a market condition. You want more information, take your phone and you can do a little viewfinder thingy.
That's awesome.
Julie, question?
I do. Is there a way to check sponsors with the SEC for prior violations acting as an LP?
You actually can. I'm pretty sure you can just go and look up their name at the SEC site. Just like you'd look up any fund someone's doing. Most people don't realize this. You can pull the filing on any fund you want. It's all public documents. Matter of fact, when I file certain funds, if I just want to see what kind of information I get, sometimes I'll put that my maximum raise is 500 million, even though I'm raising 10, because they don't really care. But there are people that subscribe to SEC filings they're basically broker dealers. And you'll get some interesting phone calls if it fits the parameter, the type of asset they're looking for. Oh, I see you just filed a $500 million 506C, which is strange, but you're looking to raise $500 million. I might be interested in charging you 3%, $20,000 a month expense fee, and then a $50,000 exit fee, plus the 3% to raise capital for you. So it's very interesting. But yes, you can also look for those same people. You'll see it when you look up their names. If you're curious of people under investigation, you're welcome to send me an email and I can tell you yes or no based on my knowledge. There are some people that some of us know, not even people, they're big groups that are under serious investigation. The bad group that's coming, the policing is coming from the Salt Lake City office of the SEC. They have a guy there who has, I want to say that terminology, who really, really, really wants to bust people and has dropped down into kind of our social media realm and has caught a few people. I've got 4 clients that are investors in one group's deal that have been asked to save all their documents for the ongoing investigation. So anyway, yeah, you need to be very careful. That goes back to picking your sponsors. Listen, as a passive, you should ask the same stuff. If someone's not willing to answer the hard questions, move on. This is your money. It's your money to lose.
Okay, I got a couple questions and then we got to move on. So, gosh, tons of information here. I would actually, let's open this up because I think it needs to be heard from the person's mouth. Let me see. Let's go to gallery view. Jonathan New, I know you had a question. Can you go ahead and ask Merrill?
Yeah, thanks, Merrill.
We're all buddies, man.
Yeah, you know it, man. We had a good earlier time on the conference. But anyway, everybody talks about the 506Bs and the 506Cs. But there's other kinds of offerings that we can get into, like Reg A's and Reg A Reg crowdfundings.
Yeah.
What are your opinions on the differences? Obviously, the Reg A's cost a lot more. They take a lot of time, and you got to go through a lot of scrutiny with the SEC for auditing. But as far as like opening up like you said, a blind fund, it seemed like that would be the best way to go. And the fact that you can openly advertise to unaccredited and accredited alike, even though I know that the unaccredited, they can only invest a certain amount of money, but it seems like that would be the best way to go for like the blind fund.
So Jonathan, I think you answered your own question, but that was very good. So I'm slightly opinionated, as Julie knows. So I would tell you never do a crowd fund for any of the type of deals we're talking about. It is a nightmare. And depending on how much you're trying to raise, you can't even qualify for it. So I would stay away from that. Nobody here wants to go through audited financials. Okay. I'm probably the only one here who has set up a couple funds where I voluntarily said, I'm going to do audited financials. Does anybody know what audited financials cost? Tandy? No. Nobody does. It's between 35 and 50 grand a year to have your financials audited. It's not just that. It will cause 2 or 3 of your employees, because you have to have your own accountant in order to do that. It'll cost them to lose 4 weeks of their lives. Now, I wanted to target family offices, and a family office will never invest in a fund that doesn't have audited financials. So if I'm going to do audited financials, Jonathan, I'm going to do it on my terms. I'm not going to do it because the SEC is requiring me to do it. I don't want to do anything where I've got to have more and more and more regulation and oversight. If I'm ready to do that, then I'm just going to go make a public company and not make much money and hope my stock makes me money. So my general rule there, there's 505 A. I understand all of that. I think you're complicating a free lunch. That's what I think you're doing.
Cool.
But good question.
Who else has a question?
Daryl, no questions?
Daryl Murphy, you got a question? No questions. Who else?
No questions.
Anybody?
Okay.
Thank you, Daryl. Anybody else?
Free legal advice. I'm not going to bite. I already yelled at Lila. There's nobody else to yell at.
Jim Biggs is in the house. Good afternoon, Jim Biggs. Who else has a question? I mean, we've covered a ton. I know that there are some people out there that have a question.
I have a question.
All right, Dorian, and then was it Mandy?
Mm-hmm.
Okay, let's go with Dorian first.
What about when raising capital from foreign investors from other countries?
Dorian, was it you that said you have foreign money?
Yeah.
No?
Okay.
Oh, okay.
No. What?
Somebody said initially they had foreign capital and they were interested in bringing it in. So you have
That's Eddie.
Eddie, sorry. Well, this will go for Eddie too. You need to be cognizant of, one, where the money's coming from. Obviously, we have OFAC issues. 2, in what capacity they are investing. Are they investing as an individual? Are they investing as an LLC? Is an LLC a foreign LLC? Or you really hope that they created a U.S. LLC to make your life easier, and then it's just a normal type of investment. You have to look at why they're investing. Is it I'm not trying to be political. There are certain places you cannot take money from currently. Okay. And you need to make sure, as someone bringing in foreign capital, that money is not being routed through a place that is taking money, but coming from a place where you can't get the money from. I know that sounds complicated, but foreign investors, listen, I have family that live in Israel, and I've taken Israeli money, which is just as good as U.S. money, but it creates an entirely it creates an additional requirement for you as a syndicator. You have to hold back a % of the profits that are distributed, and you have to place that with the IRS. You're kind of a fiduciary until you place it with the IRS. Then it's up to your investor to file their taxes, and then they get a credit for the laws in Israel to offset some of the taxes here. That's fine, but I don't like having the extra fiduciary duty as the manager of a fund. I got enough problems with Americans. So now, if a foreign investor comes in and invests 10, 15, $20 million, I can make it my problem. But a foreign investor who's putting in 100, 250, even 500, for me personally, doesn't make a lot of sense. But there are ways to do it. I think one of the easier ways is actually to go through Canada and have them create a Canadian LLC. That's very popular in California. It's very popular along the West Coast. But there are all sorts of things. You can create a blocker entity in the islands, which sounds very kind of nefarious, but it's really not. You can go through a Bank of America, Merrill Lynch, you can go through JP Morgan. They all have offices in the islands over in the Caribbean that are not U.S. islands, and they create an entity and they invest through the entity. A blocker, it blocks some of the taxation, but it's a $50,000 to $75,000 structure. Not something we do, but we have clients that have done that before. Hope that answered the question.
Thank you. Mandy.
So first off, Merrill, thank you for all of this. And as someone who used to do improv comedy, I want to tell you that you've got a real future in it if this whole lawyering thing falls through.
It's
I'm just saying.
You're
So
awesome.
in terms of the blind fund setup that you were talking about of collecting 20% and then doing a future capital call, talk to me a little bit in terms of what you're seeing in terms of returns on that first 20% while you're holding it.
nothing. You make no promises. If I'm advising a client on structuring that way, they can put in an interest-bearing account. But I think Julie would be in agreement that, you know, if you can get a 0.5% interest right now in an interest-bearing account, what's the point? So what we tell them is, now, if you want to pay them interest while it's sitting out there, that's one thing. The reality is, if you move forward on a deal, they're going to get the equivalent of their return back when the deal is done. I have mixed feelings about taking partial money up front. I would rather take all the money up front and find a deal. The downside is, if you've never done a blind fund before and you succumb to pressure, month 3 or 4, you may have put in your PPM 6 months. In 6 months, we don't have a deal. I'm returning 100% of your money. Okay. It doesn't matter. It doesn't matter if they've read it. You're going to start getting phone calls in 2 months, more in 3. Just about everybody's asking you in month 4, hey, where are you? Where are you? And so now all of a sudden, Mandy's going to have pressure trying to go out and find a deal that Mandy might not have gone after had she had more time. So that's why I suggest to people, you know, almost like taking a retainer or a deposit up front. You're relying on that deposit. So you provide a penalty provision, maybe not as onerous as I first said to Lila, you know, you lose everything. That's very New York style. Let's go kind of California where, you know, you get some fairy dust and you get some sprouts thrown at it. I'm just kidding. But avocados, there you go. And asparagus. And you take 10%. And so someone invests 20 grand out of 200, you keep 2,000, you disperse it amongst the other investors. I would not ever promise a return or an interest rate. Now you can put an interest-bearing account, put it with a title company. They put an interest-bearing account, and you know it may make a 0.25% interest. Yeah, you can't keep the interest. That's you don't want to keep their interest on their money.
Got it. Thank you.
Thank you. If you have a job for me, stand up. Law sucks.
Oh, I got you. All right, let's talk.
Yeah, we'll get you covered on your second. 1031.
I got a question.
Hold on, Eddie. I got one first.
Okay.
1030.
1031s.
1031. Cannot.
Go ahead.
Can I do a 1031 into a fund that is a blind fund? Open fund?
Maybe. It's going to be very difficult. Listen, our general recommendation with 1031s, and I hate these type of structures, hate them, but we do them, is find other 1031s and do a tick.
Yeah.
Tenant in common agreement. I'm just telling you, there are going to be very few people that will take 1031 money in a structure that allows them to take in non-1031 money and pull it together.
Even in a fund, you're telling me it's not going to be placed after the 180 days. How does that work?
Okay. It has to be placed.
Okay.
So it has to be, you have to close. So you have to close on a property. It's not putting it in a fund. It has to close on a property.
Okay.
Remember,
so that's just standard.
It's
standard operating.
It's like kind asset. So it's got to close on something. It could be a ship. You could buy a boat, a big boat.
Yeah, you got one for sale. Eddie, what do you got?
So I got a question. So if I take on debts, right, you know, similar to some of the European structures, you take on debts in a foreign country, and then you invest it into, you know, a LLC in the U.S. side. And if I'm a U.S. citizen, does that, you know, basically go through the whole process, and instead of setting up a fund, well, you know, I could take on debts in the foreign country.
Right. But Eddie, if you're coming to me and saying you want to invest $500,000 in my company, in my LLC or my fund, and it's Eddie Wong who's investing in it, I don't give a shit where your money came from. Excuse my French. But if you're telling me that Tehran is sending you $500,000, or actually you're sending me $500,000, the wire comes from Tehran, I'm going to have a problem with that. Because,
Correct.
but at the end of the day, I don't want to say I don't care where your money came from, because that's like Ozark. And so, you know, your money is supposed to come from legitimate sources. And I'm not saying that's not legitimate, but you do bring up a very good question, Eddie, and that's a good question. But you bring up another topic. If I loan Julie $1 million and she raises $4 million and she closes with whatever the rest in debt, do you know that $1 million that I loan her is the sale of a security? So let's say you don't want to raise capital, and Lila says, screw this. I want to go back to my New York ways, and I'm going to go just pay some hard money lender, you know, because I know I can just pay them an interest and then I'm done with them. They don't get in the back end. She technically should file with the SEC. Technically. Most people don't. Most people don't worry about it, but we have had clients that have said, hey, listen, we want to structure these as a loan instead of equity, which is weird because it's really hard to get a loan on top of a loan, but we want to structure them as loans instead of equity because it's the return of interest, and interest is taxed at a lower rate. And because we can save on legal fees and we don't have to pay your exorbitant fees to do a PPM and blah, blah, blah. And you don't have to pay for that when you're in jail, is what I told them. Catch that? You don't have to pay for that when you're in jail. It is still considered selling a security if you are, essentially what you're doing is you are giving an ownership interest in your deal in exchange for a note. But the reality is it's just couched in the form of a security. There's some gray areas you can kind of get around it. But my general recommendation to everybody on this call is, and we're not the most expensive law firm. We're probably right in the middle. Don't go cheap on your lawyers. You're going to find this hard to believe. The lawyers make the least amount of anybody, any third party you use on any deal. I will guarantee it. I could triple my fees. I would still make nothing against Julie. I would make less than Julie or less than Old Capital. I'd make less than the broker, less than the insurance company, definitely less than your capital expenditure GC is going to make. And I'm protecting you the most. And so strong advice, whoever you guys choose at whatever point you're ready, don't judge your law firm or your team based on what they're charging. That doesn't give them a right to gouge you, but typically you are going to get the protections and the value as to what you pay for. That's it. I mean, and honestly, Julie probably doesn't like me saying this. Old Capital is not the cheapest when it comes to points. They're not. I don't mind saying it. I don't have any problem with it. If I have to pay an extra half point or even a point, one thing I know is they get me to the finish line. I've already had a couple deals personally and with many clients where they've gone with someone who's only charging half a point, and it really didn't matter, and it really had nothing to do with their numbers at the end of the day. If you can't close the deal, it doesn't matter what you got charged. You're done. You're never going to be raised capital again with other partners. It's horrible. So, and that's just generally speaking. And that's why, and it's not to say Old Capital charges excessive points. They don't. I was a hard money lender. I charged excessive points, but I made sure every deal closed, and I was your lender of last resort. You have nowhere else to go, so you're coming to me. But I don't even think twice when I see Old Capital's fees. It doesn't mean anything. I use another firm that I know is good on litigation because I'm not looking for a $150 an hour lawyer. I'm looking for a lawyer that gets rid of the deal. They get rid of the lawsuit instantly. So if I have to pay $450 to do it, okay, so I'm paying $2,000 to have it dismissed, or I'm going to pay $5,000 billed at 40 hours to have someone take it all the way through litigation. So just think about that though when you're picking your professionals. Julie.
I have a question from Chris Tao. He has been so quiet. He wants to know, can you talk about finder's fees? And I think that's our last question, unless there's more.
That was my
I've
first.
overstood my commitment to my people here.
Your people? What about me? I'm doing this for free. Chris must have missed the first part of our discussion, which was essentially, so right now, finder's fees, don't do them. If you're going to do them, don't come to my firm asking for representation, period. I don't want to get involved in it. I don't want to do your pretend workaround. I'm just telling you, I don't want to do it. I can show you 4 investigations right now by the SEC into groups that some of you may or may not have heard of. Don't do them. If you really want to do it, wait until Q1. The SEC just put out some rules I talked about at the beginning. If Julie allows, I'll send the clip from an hour ago that I just did with the presentation. Hold off. Don't do it. Don't pay people finder's fees. If you're going to do that and you're absolutely adamant about giving somebody something for bringing in capital, you better make them your partner as a general partner, and you better give them real responsibilities. If it's fake, it'll be busted by the SEC. I already see that going on right now. So if you're going to bring in, someone's going to bring in $4 or $5 million, you make that person work for it because you're stuck with them just like they're stuck with you. And, investor relations, yeah, so they send an email out to their $4 million once a year. SEC is not going to buy that. They have to be part of meetings. They have to make decisions, stuff like that. So no finder's fees, Julie. Or
Okay.
Chris.
Tim says he's got one question.
Okay.
Chris, no, Tim.
Tim's sleeping. We have a
No?
picture.
Okay.
Did he leave?
No. Sorry about that. Can you guys hear me?
Yeah.
There you go.
Can you hear me? All right.
Yep.
Sorry, you were on mute. Merrill, thank you. I mean, you bring a lot of great points about your services and what you do for everybody here. I have 2 questions. My first question is, can you talk a little bit more about vetting those foreign investors? How do you actually verify where the money comes from? Because you mentioned something about, if the money comes from one of those questionable countries, where do I get a list of those countries? Or if they're bringing money through U.S. banks, $10 million, $15 million, $20 million in one transaction, how do I make sure that it's a clean money and I'm not going to be slapped or penalized from Securities and Exchange Commission? That's question number 1.
Okay. So there's actually a pretty easy answer for that. And we're fortunate enough that pretty much your lender will prevent any of those transactions from ever reaching your bank account. That's the simplest question, the simplest answer. Eddie may already know this too. Your lender is going to do so many more checks and holds on the money. You cannot wire $10 million from Asia, Africa, Europe without it being held right now. Okay. And if it's coming through the islands, it's going to be held. Now there's certain countries, Israel, England, some others may not be as much of an issue, but your bank is already going to do the check. But what you want to do is you want to make sure you've talked to the source of the money ahead of time so that you personally know it's good money. Because if you're waiting on $10 million to hit your bank account and you close in 3 days, that's going to be a big problem for you if they lied to you, or a big problem for you if you said, oh, hey, it's coming from, Al-Qaeda. But I know they're the nice Al-Qaeda, so that's never going to show up. And then they are going to look at you. They will look at you and you will be guilty until proven innocent because it's going to be combined with terrorism. So I would just be very careful. I'm not saying not to do it. I'd be very careful. Make sure your foreign investors are vetted. Me personally, I'm Staples. I press the easy button. I get foreign when I can get plenty of domestic, but some people I have simple Asian clients that have lots of Asian money that comes in, and it's fine. It takes 15 days sometimes to clear wires.
Okay.
Is there a second question?
Just to clarify, this has nothing to do with Al-Qaeda or any of that.
I know.
We're good with that, Tim.
The investor has. Okay. Great. Second question. So let's say you're a co-sponsor or somebody's a co-sponsor on a deal. They're going to be doing everything that's necessary during the syndication. Is there a way to protect your investors from the general pool investors of the main syndicator and basically have them kind of like in your own CRM and have them kind of like to be managed separately and do the distribution separately? Is it still possible, or you have to do like a fund to fund kind of deal? How does it?
So, yeah,
is it possible?
No, that's a good question. So, Julie, real quick, the question is simply, how do I protect my investors from my partner's investors, from my
Yes.
partners? And so that's really the age-old question. You're not going to like my answer, so I'm gonna give you a two-part answer. There's reality, and then there's what you can do. Yes, you probably could create some sort of CRM. You could probably initially create a non-compete document between you and your partners, and you would list each one of the investors that you have and each one that he or she has, and you guys don't compete against each other. That would be probably the best thing to do. As far as hiding them, all partners are entitled to the Exhibit A to the operating agreement, which lists all the investors, and your CPA is entitled to it. I mean, you can't do your K1s without it, so it's going to be pretty hard to hide it. So you could create a document. But the bigger issue I would suggest is, if you have to go to that length, you are with the wrong person. You're with the wrong partner. You're with this partner for 3 to 5, maybe 7 years. And if you're worried about this up front, you got to pick a different partner, or you've got to look deep inside and try to figure out what is it you're trying to do. Because it sounds like, not you, because we have lots of people to ask these questions. It sounds like you really want to do a solo deal. But you've got this other person that helps you do the deal. If I'm going to do a deal with a partner, I don't hide anything. If I bring in investors and my partner has another opportunity and the investors think it's a good opportunity, I have no problem with my investors investing in them. Because you know what? It makes me look good because I brought them to him or her. And on top of that, my investors don't just have 50 or 100 grand. I don't like those type of investors. I won't take them. We screen our investors before we take them. It's a privilege, I hate to say it, to invest in our group. We don't just take you. I don't want somebody, I want someone that's got $1 million, $2 million, $3 million to invest, and I'm just a piece of that. So I personally don't worry about it, though I do understand, especially people who are getting with partners they may not know, it's a big deal, but it's kind of like prenups. I hate to analogize partnerships with marriage and non-compete with prenup, but it is what it is. And I'm not a big fan of either one of them, but I'm not getting married again, so I don't care. I'm stuck with the one I've got.
And she's a good one.
Great point. Thank you.
All right.
Thank you, Merrill. Great
Thank
points.
you, Tim.
Sure.
I do have one more question, and then we're going to close it up. Angel has a question. She mentioned that she's trying to get a bunch of teachers to make sure that they have extra money.
Yeah.
Angel is interested to know, how do you start a fund for teachers?
Oh, that's an interesting question. Because didn't she mention 2,000 teachers?
Well, I mean, I'd like to help more than that, but 2,000 seems like something I could do fairly quickly.
Yeah, I mean, so look, in that scenario, I'm not ragging on teachers, but I kind of know the general median income of teachers. If they're single, they're probably not going to be accredited investors. They could have a spouse, male or female or whatever. To be careful, right? I'm talking in California. They could have a partner. I think the definition is partner in California. They're different states. They could have a partner that makes enough that combined they meet the accredited requirements. But my guess is you're dealing more towards, I have a teacher, I'm using Texas salary. She or he makes 50 to 60,000 a year, but they want to invest some money. That is something potentially you could look at for doing not blind fund. The Reg A. It's a crowd fund. I would caution you, be careful what you ask for, because having 2,000 people that each invest $10,000, that's a hell of a lot of correspondence for not a lot of money for you. Now, I know you're doing it for the good. You're doing it because you want to help people, and I applaud that. But, I might argue that, maybe one way to help people is to go actually do bigger funds, raise bigger money, and create a non-for-profit, a 501c3 that donates and maybe educates teachers on how to invest and do their own deals and does other things, where quite honestly, your money might be, your impact might be even greater with those teachers. We have quite a few clients that when they make an offer, and here's something you guys should think about, when they make an offer, they state if this LOI is accepted, they'll donate $25,000 to a charity of the seller's choice. I can't tell you guys how far that goes with a seller. You'd be shocked. It's highest and best offer, highest or best, excuse me. And that keyword or. There are sellers out there that place ethics and morals just as high and sometimes higher than money. So they may have someone that's willing to pay a couple $100,000 more, but they see you're offering to take 25 grand of your own money and they can put it in their charity. Oh, these have to be good people. I know they're going to be able to close. They got to be the right type of people to work with. So you never know, stuff like that helps, but you can do a lot of good with some of these 506Bs and Cs that you're raising. It doesn't all have to be money. And I mean, you have to have some money, but you have a lot of power that you can use with these. And based on what you decide to do, you can get different types of investors. There are investors that want some intrinsic value aside from just money. They want a feel good portion. That C or B class may not be feel good, but the fact that you provide money to veterans is a big deal. Or the fact that your property that you're going to buy, you're going to give a 10% discount to all veterans and first responders. I like veterans. I'm very pro veterans. Thank you for everybody out there who is served or is serving. But so we do stuff like that. I'm working on a fund right now of short-term rentals. It'll be 506C, but it's still in the work phase. But the short-term rentals, it's a 15% across the board discount to any veteran or first responder that uses any of our short-term rentals. No questions asked. And we're going to donate money to one of the veteran organizations. It's something that my wife and I feel very strongly about. And it's amazing when I put that as a suggestion to a small group of people, every single one of them agreed with it, which is good. We're probably going to add the Blue Line stuff to it too. They're first responders. So you can get a lot of feel good stuff out of what you're doing. And quite honestly, it makes you feel good too.
I love that.
Preaching.
All right. I think we need to close up with you, Merrill. I so appreciate it. I don't know if we should do a breakout session or you guys have had it. Do you guys want to stay another 10 minutes? Yeah, I think we're done. So I apologize for that. That is the direction we're going, but I know that Merrill has so many, some real gems that he dropped to us. So I apologize for that. And the intention is always to do breakout sessions. So Merrill, thank you. Rob, thank you. Roxy, thank you so much. Who else is on here from you guys? Oh, and Tandy. Thank you, everybody, for joining us. I so appreciate your support and really helping all of our community understand the fund situation. And I will hopefully pick up the phone and we can chat about that more for me.